world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Radboud Vlaar is the founding partner of Finch Capital, an early-stage venture capital firm and one of Europe's most active Series A investors. Prior to starting Finch in 2013, Radboud was a partner at McKinsey. Finch recently published a fantastic report on Fintech in a time of crisis, with expectations and projections for the impact of COVID on the fintech industry now and in years to come. The report, which forms the basis of our conversation today, is available on Finch's website, which we'll link to in the show notes. For all of our past episodes and to sign up to our newsletter, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Radboud Vlaar. Radboud Vlaar, welcome to Rebank.
Thank you. Pleasure to be here.
It's great to connect with you. I've been looking forward to this. Your colleague Aman and I have a great working relationship. He's a very smart guy with a lot of experience in this space, and I think he joined what's now Finch Capital maybe a couple years ago.
No, 16. Yeah.
A handful of years ago. Time flies. And you are the managing partner of Finch. Can you quickly introduce yourself and tell us about Finch?
Yeah, so my name is Radboud Vlaar. We started in 2013. Before that was 10 years with McKinsey, very much focused on the financial sector as well as private equity and corporate finance. We invest in Europe and in Southeast Asia in financial technology, which includes enabling technologies as well as disruptive technologies, and also are active in the artificial intelligence and IoT areas, mainly in Europe.
Great. So I think that European plus Southeast Asian focus made you guys quick to start to wrap your heads around what was happening with COVID-19 in, I guess, probably from your perspectives, January onwards. I remember, it must have been, I don't know, maybe March at this point, early April. I think I was still trying to understand, it must have been March. I was still trying to understand whether this COVID thing was real, whether it was here to stay, or whether it was going to, as I hoped, disappear overnight and never be heard from again, which of course didn't happen. And while I was trying to make sense of the entire situation, you guys were already putting out a very detailed 26-page slide deck on the impact of COVID on fintech, both now and over the next 4 or so years. A deck that is extremely detailed, extremely insightful, and that I thought we might dig into a little bit more today, because there's such rich content in there, a lot of which I think warrants a much deeper discussion. So firstly, compliments on an excellent piece of work so quickly.
Thank you.
At one point I read that Finch is the most active fintech investor in Europe. Is that right?
We're the most active Series A investor. That is correct.
Wow. Most active in Europe. That's impressive. Can you talk about some of the companies that you guys are involved with right now?
Yeah, so in the UK, we're involved in companies like Good Lord, Trussell, Zopa, and in continental Europe, companies like Hyber, which is more in the IoT, Bucks, which is in trading, Fixico, which is in market repair for insurance companies, as well as fleet operators or ride-sharing companies, in tokenization for investment funds, the Brick Block, and then in Asia, several companies very much centered around Indonesia, a bit more B2C focused than the European, which is for a very large part B2B focused. In total, we have 35 investments, the majority in Europe.
Excellent. You guys are busy. So to dive into this report, maybe it's worth first talking about the timing expectations. It's an important part of all of this as people start to try to make sense of what's happening now and how long this is going to last. So I believe your initial expectation, at least, was that this quote unquote crisis mode would last until the third quarter of this year, after which we'd see kind of a 12 to 18 month recovery. Is that still your expectation? And I guess what inputs went into that thought process?
So I think what we did at that time is we looked at a couple of sources. So one is we looked at how in previous crises, both financial crisis as well as pandemic-led or driven crises, how long it typically took to recover. That's one source. Second, we looked at several investment banking predictions, what their perspective was. And I think what you will, at least the perspective we took out of it, is that it will take at least till the end of the third quarter to be in more crisis mode, with the recovery starting then as of Q4. So I mean, and I think it could be, if you look at where things are now, I think maybe some of the things are going a bit faster. I think it could be July, June, maybe a bit earlier, but it all depends on how quickly the lockdown is being softened. So I think we still stand with our conservative, maybe looking also at the past till the end of Q3. But with a little bit of luck, it could move a bit faster. But this very much depends also on when travel restrictions are being removed. And that's which we think is, to be safe, more realistically after the summer than before the summer. But I think we'll know every week or month, we will have more clarity on it. But that's still our perspective. And the recovery typically takes longer than people think. I think it's already hard to slow down a society and the economy, but it's probably even more complicated to bring it back. I think you will see a quick recovery in GDP percentage-wise, but that doesn't mean that it's back to the old level and old momentum. I think there are a lot of other complicating factors, like how supply chains will interact, how the different countries are dealing with opening up. I think some countries have already said till the end of the year we're semi-closed. Now, so a lot of interdependencies there, which make us still think that it will take till Q1 2021 before we're really in the recovery and getting into a new normal.
Does it sound like your investments are in large part UK, Northern Europe, and Indonesia?
Yeah, so I would say including Switzerland, Eastern Europe, very much Poland centered, but I would say it's the northern half of Europe. So we have 2 investments in Spain, but no investments in Italy, Greece, or that part of the world. So it's more the northern half of Europe, including Eastern Europe, primarily Poland.
What has the situation been like in Indonesia?
I must say the speed at which they changed from normal to being in lockdown was way faster than what we have seen in Europe. I think probably similar to what you see in countries like Singapore. I think some of these actions were taken and very quickly implemented. If you look at the numbers, I think the impact on the health side is so far seems to be manageable, although there's a lot of connectivity between China and Indonesia. But yeah, I think also the question there is when it's opening up again, and also that's more June, July from an opening up perspective. But I think in general, countries like Indonesia are more used to crises, whether it's floodings or whether it's economic crises, or than the Western world. So I think therefore there's less disruption in the day-to-day working than there is probably in the Western world, who hasn't have had that many shocks to deal with, and therefore it's all completely new.
So one of the things I loved about this report is that, especially in the early stages of this experience, I guess once a lot of people started to finally understand what was happening and what the lasting implications were likely to be, the conversation quickly became digital is going to be the way that everything works going forward. And while that may well be the case, you guys actually got into the thought process and the detail around how that will happen, specifically in financial services and fintech. And one of the things that I think you guys determined is that financial institutions will turn to tech companies rather than in-house resources to accelerate their digital developments. And that totally makes sense. One, because in-house resources are going to be strained. People aren't going to have necessarily excess capacity to be deploying against some of these digital challenges. And also, hopefully, we've kind of reached a tipping point, and even the most entrenched organizations realize that digital is real and it actually serves a purpose over and above press releases and UX. So maybe we could just dig into that point a little bit. Financial institutions will turn to tech companies to drive digital. I guess that could mean a few different things. It could mean fintechs like those that you guys have invested in, like we have on the podcast on a regular basis, or it could mean that FIS picks up a bunch of new deals because even in the best of times, it's easier to buy the proverbial IBM, and now we're in likely a more risk-averse environment for a period of time. So how do you expect that dynamic to evolve? Are incumbents going to look at fintechs as a route to the solutions that they need, or are they going to be overly conservative and push more business to traditional IT vendors?
Yeah, so what we were trying to, let's say, the underlying thought behind this is that the crisis, but especially the lockdown, as a result of that, forced a lot of people to work remotely, interact remotely with financial institutions. So that revealed for a lot of financial institutions, where it's bank, insurance, payment companies, you name it, where actually they were digital ready and were not. Also, it revealed for government regulators where the way how people buy houses, buy goods, there is inefficiency in the system that, for example, slows down or completely stops certain type of activities. Think about the purchasing of a house, which is an important element also for retail banks from a mortgage point of view or for rentals. I think it revealed where these processes were broken. So what we expect to come out of that is, on the one hand, regulation to enable more things to go digitally, but to your point on the use of technology for financial institutions to exactly, let's say, it was like a stress test where they got very clear areas where they need to fix or implement or accelerate technologies that enable them to work more digitally. Now, as a result of that, I think historically a lot of financial institutions have developed their tech in-house with the help of consultants, but was more in-house, custom-made build. And what we expect that, as there are so many financial institutions out there and a lot of the processes are quite standard, that they will look for more ready-made solutions. Of course, there always is an element of integration into the legacy systems to accelerate and fix certain type of the modules they have. Now, whether that will go to incumbent tech providers or to call it more newcomers, I think the companies that are very young, just have a few employees and one or two clients, maybe they're not the ideal candidates. But I think the good thing is that with all the investments over the last years, a lot of companies are actually, call it in the Series B phase, where they have 5 to 10 million revenues or more. They have several clients and they have a product that has been tested already by this client. So we expect to see an increased usage and decision making in favor of working with some of these companies over doing things in-house. And of course, there will also be established companies benefiting from that. But I think speed is something that will be important because what at least we have seen, a lot of the CIOs and CEOs have reduced a lot of the cost, but have accelerated prioritization of digital initiatives also with external vendors. So it will be a mix, but generally it will accelerate the shift of using in several areas more ready-made solutions rather than building everything in-house.
Can you talk a little bit about your expectations for the winners and losers in fintech coming out of this, and perhaps more by sector than specific company necessarily?
Yeah, I think within every sector, even if there are winners or losers, you will still have relative winners and relative losers, which I think is much more linked to whether they have cash at the moment or not, and whether they can navigate through this crisis rather than the pure sector they're in. But in addition, there will be sectors, which we call them the winners or the more challenged ones, that will have a more difficult time ahead. And that can be difficult in terms of justifying the valuations of the previous rounds, because growth outlook or profitability outlook could have changed, or it could be challenged in the terms of a complete drop of volume, like their business models where suddenly clients they were serving are no longer as fast growing or as able to engage with these parties. Now, the winners we see we think overall that there were two areas, if you take from a macro point of view, looking at the pockets within the financial service sector where limited disruption took place, which is in the mortgage and the life insurance area. That is because partly regulation required certain in-person, partly because it was an area where people maybe were not always comfortable interacting in a digital way. Now, we see there that governments and regulation are at least enabling these processes to be end-to-end digital because they would like to see continuity also in future events, if future events like this happen, and the same for life insurance. So we just see an opening up for a more digital interaction model. I think you could see that trend already in the UK in general, in the real estate, piece by piece, whether it's first the parties like Supla, then it was the purple bricks, and so step by step, part of that real estate process have been digitalized and moved to a more online model. And now you see the players like Trussell and Habito and other models, they will also benefit from that. But of course, also traditional banks will also, and brokers will move on that trend. But we see that as a general trend shift there. Then on the consumer and SME lending, I think what you see in a lot of cases when there is a recession is that traditional players are, especially the ones that have big legacy books, are slowing down and getting more conservative, partly also because they are not always effectively using dynamic-based risk and behavioral-based risk pricing. And that's where we see an opportunity for the consumer and SME lending players. I think a lot of the P2P players have moved into more balance sheet led, but different type of players active in this field that you can do very healthy pricing. Supply from some of the traditional banks might be less. Actually, a lot of the banks have closed down their branches, so de facto don't have this in-person advantage anymore, maybe even a disadvantage. And that's where we see the opportunities there on the fintech disruptor side. On the enabling side, we see across the board, and we see that in our portfolio, is all these companies that are providing digital solutions for banks, insurance companies are already benefiting now, and on top of that, will see even more growth after that. So think about KYC. A lot of parties required in-person meetings, especially in Southern Europe. You saw that in some of the banks, and with more digital KYC-led processes. We see players providing these solutions like a Ford line, and Onfido will benefit from that. On the artificial intelligence side, I think there will be a lot of pressure on cost and on return on equities for the financial institutions. So another way to bring down cost further. Providers of solutions that can help. Think about insurance to handle the claims. Think about car insurance, where there are issues of how to do that in a more digital way than driving to a garage and doing everything in person. So a general pressure to move things digital. These solution providers there are benefiting. And the areas under challenge, under pressure, what I mentioned, I think there are a lot of challenger banks launched. I think clearly several of them will come out very well, especially those that have cash. Question, of course, is valuation. What are the valuations? Are they still justified? Or did the outlook in terms of revenues per client, growth, is that changing? I think a lot has been written about that in the last weeks. Also, wealth management, and especially also the FX players, as there is a reduced amount of travel, and as a result of that, also less FX need. So that's a bit more the high level perspective which we see there. But again, there are lots of areas where on itself nothing is changing, but because startups run out of cash, they come into difficulties because the funding market is just more difficult at the moment.
Yeah. Can you talk a little bit about your views on the payments space in general? You talked about FX, and sure, lower travel, lower business volumes would suggest lower FX volumes, and then therefore a bit of volume and revenue pressure on those types of firms. But it seems like the payments industry in general, you may expect to show some weakness over the coming years, potentially even post shock, if I read your analysis correctly. Can you talk a bit about that?
Yeah, so I think within payments there are, of course, lots of different players. So for player focused on the point of sale, more the PSPs focused on the e-commerce side, the players doing remittance, players doing FX transactions for SMEs. So there is a wide spectrum of players involved in the payments. So if we take maybe piece by piece, I think if you look at the point of sale, I think in general, of course, there was first a big adoption to put all the terminals in place there. I think the good thing is the positive side, there is a shift towards even more a cashless society than there was before. I think a lot of governments have also actively stimulated people to pay electronically. So I think that is helping there. On the other hand, during the lockdown short term, there are a lot of challenges. A lot of their shops and places and restaurants where their terminals are installed are closed. And long term, there is the question how much that all will come back and how fast. So we expect that the recession as a whole and the economic slowdown is not good for this point of sale part. Then on the PSPs, I think there is, you see at the moment in the payment service providers, there are pockets where there is high growth and there is pockets where they have like 70 to up to 100% decline in volume. So the areas of travel, bookings, tickets, swapping for concerts, the payments for, I think everything which is related to travel, entertainment, I think are massively down. And on the other hand, you saw that a lot of people were ordering goods on, think about sports equipment or goods at home and also food delivery. So I think you see there, depending on what type of customers the different PSPs were focused, it very much determined the impact it will have on their business. Now, what we think now, so the impact might look less dramatic than it maybe really is. I think post, call it the crisis situations, so let's say as of Q4, the big question is how quickly will travel rebound, and will the e-commerce stay at that level, or were people just doing a quick boost to get the stuff they needed while the lockdown and as part of the recession reduce their spending. Our perspective is that it will take longer than people think before travel and all the local travel activity and entertainment comes back, and that the peak in ordering goods during lockdown that will gradually slow down also as part of the more recession situation. Now, and then on the FX side, I think in general we feel that recession is not good for trade, for the growth of that. I think on the consumer side, people are traveling less. So overall, that the FX part is coming down. Of course, volatility could be good for spreads, but volume-wise, that the growth outlook is less good as it was. And for remittances, that it depends very much whether the senders are also not hit by the economic crisis and therefore have maybe less money to send abroad. So across the board, I think for different reasons in the different sub-segments, we feel it is either staying the same or more challenged. And in the short term, you see a very blurred picture. But if you look underlying, there are different factors playing a role.
Yeah. And I guess similar question in the other direction around InsurTech. So I know that Aman specifically has an interest in InsurTech. I know that you guys have a number of InsurTech companies in your portfolio. It's not an area that we've seen really fulfill expectations, I think, at scale in the way that we may have expected and in the way that other areas of fintech maybe have so far. But it sounds like you guys are quite bullish about various subsegments within InsurTech now and coming out of the crisis.
Yeah, so I think if you look at our report, I think part of it is what people call InsurTechs, because I think the ones where we're skeptical to neutral on is more the disruptive side of InsurTech. We think across the board, like you said, there was a very high hope, high expectations. But so far, if you look at the impact they have had, I think it's a different story than what you saw, for example, in the challenger banking side. And where we see a lot of potential and actually a lot of traction is, I think, what you maybe could call AI, IoT, or software companies, or companies that are selling their solutions, data, and products to insurance companies to help them reduce costs, better serve their customers, etc. And that's, I think, for the outside world, not always called InsurTech, because some of these companies might also serve other industries. But that's where we see increased appetite of insurance to work with these third parties, but also following the crisis, increased momentum to digitalize further their solutions, products, and interactions they have. So think about claims handling, think about analytics, IoT, so software. I think a lot of insurers realized that some of their processes were very traditional based and are looking to digitalize that further. So across the board, we see there are a lot of opportunity. There's also an area where a lot of the insurers have tried to do that first in-house with their internal projects and see that and have realized that maybe that took too long, cost too much, and we will see more partnerships or usage of third-party providers.
I'd love to switch gears a little bit and talk about the funding side a little bit more. You, as a professional investor, will have great insight here, whereas people like me, more on the operator side, have less visibility. If I just generally think about the providers of capital to this space, the fintech space more broadly, there are the large name brand venture capitalists, the Accels and Indexes and Sequoias and Benchmarks of the world. There are corporate venture capitalists. There are, depending on the round and on the type of deal, strategic investors. Visa's been decently active, for instance, as have a number of other companies. And then I think over the past, probably you'd know better than me, 5, 6, 7 years, there's been a significant development in the kind of like $100 million more or less size fund across U.S., Europe, and presumably other parts of the world as well. Whereas, at least from memory and conversation with Hussein Kanji of Hoxton, circa like 2012, 13, there just wasn't much in that space. You guys were certainly early to market. I think we've seen a boom in that type of fund. How do you expect availability of capital to venture investors and to the types of firms that are supporting these fintech investments, fintech valuations? How do you expect that to play out, and what knock-on implications do you expect there to be for the fintech industry itself?
Yeah, so I think at the moment, I think whether parties have a lot of capital, little capital, or big funds or small funds, I would say in general, there has been a slowdown in parties making new investments, but maybe not so much driven by whether they have capital or not, but either by travel restrictions or just massive uncertainty how the world is playing out. And a lot of the good companies also not willing to raise money what they feel might be at a distressed pricing. So I would guess the capital availability and how it all plays out for funding rounds, I think we'll see more of that in the coming quarters rather than now at the moment. I think now it's really these companies that were close to being bust and are not able to convince their existing investors to help them, I think are in difficulties. So capital-wise, I think, like you said, there's a lot of capital available in the market from the different type of investors. I think the 100 million funds, actually, there are also in Europe, I would say there are not that many funds in the 150 million, 100 million. I think there are a lot of seed funds. There are a lot of 50 to 100 million funds, or a lot. I think it's still, compared to maybe some of the other markets, there are, but it's not like overwhelmed. I think the issue, I think, is more that there are a lot of funds that have been raised that have only raised one fund or are about to raise their first fund. And I think if there's a short history, short set of data, I think for some of those funds, depending how this crisis is impacting their businesses, I think there are funds that are focused on travel, for example. I think they're going to be hit quite a bit. I think there are funds that have no follow-on reserves, and it's quite likely that to get real value out of the portfolio, you need to be able to help some of the companies to get to a good place. So I think there are certain type of fund strategies, sector strategies, where investors in new funds might have less appetite going forward. I think if you look also at the stock performance, I think a lot of people are very bullish on technology in general. So our view is that technology investing and appetite remains there. Yes, there will be implications for maybe those funds that betted either, unfortunately, because of the nature of the sector strategy, on companies that are impacted, and that impacts their track record and their ability to raise. But I'm not so sure that the fund size as a whole is an issue. I would say, maybe contrary to what you say, I think the one thing that has really changed in Europe in the last 5 years are the 500 million plus funds, or even the 400 million plus funds. I think before that there was maybe one fund that really had the size of venture and growth more than 400 million. I think you have now Atomico, Lakestar, Index, Excel. I think Nordzone is at that range, Balderton. I think there are a lot in the 400 million range and up. And I think if you look at fund economics, to return 4 times or 3 times your fund, it requires a lot of big unicorn companies. So which returns are, from that point of view, require less big outlier companies for the smaller funds. So I think there are a lot of different factors that play a role, whether it's your first time fund, sector exposure. But I would say in general, if there is a more skeptical outlook on big outcomes that is impacting more the bigger firms than the smaller funds.
And what about the corporate venture side and some of the strategic investors that have helped provide capital?
Yeah, I think it's a good question, and I think it's not a single answer. So I would describe it that the financial sector was on a journey to figure out what type of role they wanted to play in the ecosystem. And I would say across the board, maybe most of the players were probably spending too much at too high valuations in the first period and too broad from a sector point of view. So I think what the current situation will do is I expect also a rationalization of the corporate venture capital community on where they really want to use their balance sheet, where they would like to invest, what stage. I think some of them all started with the seed funds and the incubators, whereas I think a lot of them have realized to have a real material impact on the business and companies that can deal with big financial institutions. You need to start to look more as of Series A, otherwise the companies are just too small. So we've seen a lot of that moving up to a little bit more later stage. We have seen in the beginning some of them starting investing quite globally. I wouldn't be surprised that becomes more closer to home, especially if flight restrictions are there. I don't think everybody will keep on flying to Silicon Valley, so there will be a closer to home proximity. And I think it very much differs sector by sector. Like the reinsurers have been very active. I think over the last years, not related to Corona, I think you saw them already taking a more selective approach where they invest in at what valuations. I think payment companies continue to be like the Visa examples you gave. I think continue to be very active there, but it might very well that they shift the regions. I think you see increasingly them also in Asia being active. So I expect more choices to be made, and as a result of that, less capital being available, which doesn't mean that they move out of this, because I think they also all realize that technology and digital is super important in this next years to come.
Fantastic. Well, look, you have a brilliant team. Again, I'm extremely impressed with the depth and the quality and the speed of the insight that you guys have put out. Highly encourage everyone to check out the report. It's available on your website, finchcapital.com. All the best going forward.
Thank you very much.
Radboud Vlaar, thank you very much for joining us today.
Thank you. It was a pleasure.
Thanks for tuning in to Rebank. If you liked today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.